Good morning, everyone. This is Mortgage Pros 411. I am Audrey Boissonou, and this is my co-host, Kevin Casey. We are joined today by Anthony, aka Tony Hutchinson. He is with Vantage Credit, VantageScore, Vantage. What is it?
VantageScore.
Okay, VantageScore. If he looks familiar to you, it would be because he has been many things in many places. Most recently, Freddie Mac. Remember that, Tony? Remember Freddie Mac?
I remember it was only 6 months ago.
Okay, so I'm just going to take a wild guess and assume that Tony's most vivid memories of me with him at Freddie Mac were me arguing that the algorithms that Freddie Mac was using to decide what the loan level price adjustments were going to be were all based on risk, and that there was proof that they should charge more for certain things. And I always told him it was a bunch of crap. And he would argue it wasn't. Right, Tony?
I would argue that.
Yeah.
I'm not going to deny it. Yeah.
We used to argue about that. Now he says I can talk to the people who do the algorithms at Vantage. Is that still true this week?
You can.
That was 2 weeks ago. So let me tell you, I plan to put my list of questions together and take someone to dinner, have some drinks, load them up with some drinks, and then ask the question. So
we welcome you asking the questions. I'll tell you what, the folks at Vantage pride themselves, and me being one, on being transparent. We want folks to know about the company. We want people to know the score. We want them to know what goes into it. So yeah, please, if you're willing to pay to take us to dinner, I'm willing to go. Please ply me with drinks, and I'll have my folks tell you, share with you the what makes us special.
Okay, well, I'm sure there's no planned words there. Know what the score is. Okay, so before we get totally into it, I just have a couple announcements. First of all, North Bay Camp is having a little get together tomorrow from 1 to 3 p.m. in San Rafael at the Pond Farm Brewing Company. Now that sounds like an opportunity to get some truth out of VantageScore, doesn't it? So that's in San Rafael, California. If you have a chance, and they were going to talk about the dream, the dream program through Cal HFA. And so I had the opportunity to sit in a room with Cal HFA the other day, and there are a few things that I thought were notable. Number one, she was very clear that there's a rumor going around that says that there is going to be more money from Dream for All. She said it is not true. In fact, she said it is so not true that it's more likely you'll win the lotto without buying a lottery ticket than all getting more money. So if there were any questions in your mind about whether there was going to be more money coming from this source, there it is, folks. There is not.
I saw the news article that said that, they requested more money from the governor. I'm like, well, where's he going to get it? They have major budget cuts coming.
Yeah.
There's no money.
So that takes me to my next point. You'd almost think that we had talked to each other about this, but we did not. So she also pointed out that CalHAF is a self-funded state agency. DFA, Dream for All, which no need to internalize that acronym since it's gone forever, was a different funding source. It wasn't meant to be an ongoing program. And it was originally supposed to be $500 million, and it got cut to $300 million. It was for this year, and then 500 for next year. It was cut to 300 million for this year, nothing for next year. And I think they were out in like 11 days. So there it is. So if you would like to get information about CalHAFA going forward, you can sign up for their e-news. And so anyway, I thought that was fascinating. And then just to make sure that we're all ready for what's coming up in this week, as if that isn't exciting enough, we're going to have the Fed minutes come out tomorrow. We are having pending home sales the Thursday, and PCE, personal consumption expenditure, an inflation gauge, that will be out on Friday. So as we know, all these things move markets, although because of what's going on with rates right now, not as much as we'd hope.
Yeah, well,
finally,
they don't balance that budget.
The next Fed meeting is June 14th. So we have that to look forward to. All right, Tony, let's get back to you, shall we?
All right. Whole lot of stuff going on.
Okay, so this is what I want to start with. and I know that there was a hearing this morning with Sandra Thompson talking about a few different things. So we'll get to that. But I want to start with, I'd like you to walk us through the relationship between FICO and the 3 credit bureaus, because a lot of people don't really understand how it fits together and how, and so I've heard people use the term FICO very interchangeably with some of the different bureaus. And so explain the difference between FICO and the big 3.
Okay, so FICO is its own company. I mean, that's the big thing. It's an independent organization that was founded separately. They've come up with their own algorithms for determining or assessing credit risk. And what they do is they buy the data for that from the big 3. And the big 3 in this instance would be Equifax, Experian, and TransUnion. Those organizations are the organizations that collect all of the data from anybody who is collecting payments from consumers, and they've been collecting this information for an extended period of time from multiple sources. They have their own algorithms that they use internally, but they actually have a feed that they then sell to Fair Isaacs for inclusion in their score. Where we're a little bit different from that, we are a company, VantageScore is a company that is wholly owned by the 3 credit reporting companies. Experian, Equifax, and TransUnion. So we, again, develop independently our own algorithm, and they provide the data to us to run through that algorithm. Fair Isaacs contracts out to the 3 credit reporting companies to sell their data, and they set pricing for that. VantageScore does not set pricing for ourselves. That's set by our owners, the 3 credit reporting companies. So we have no real vision into the cost that the market is seeing for us. All we know is that when people compare the 2, they like our cost. But again, we have no vision into the difference between our cost and FICO because we don't control it.
Okay, a lot like my family tree, this is very complicated. Is there anywhere that this is all written down, like who's connected to who's like, I mean, good God, did you follow all that, Kevin? Because I'm still
I did, but I got a little lost in the
yeah.
because, I mean, I understand how, like, when I run a credit report, I get the 3, bureaus, but I get 3 different reports. I got a Fair Isaac report or a FICO, but then I get a Beacon score. And I forget what the other score is now off the top of my head, but so are they really FICO scores, but they're just called something different, or is there a?
So I can't always speak to the products that FICO puts out there, but recognize that each of the credit reporting companies also has a product that produces a score. Correct. So that Beacon score could be, and I think that's an Experian. I don't know off the top of my head, but that could be one of their internal scores.
TransUnions.
It might be TransUnions, and I apologize for that. I don't want to make our parents upset about that. Me not knowing their scores or the
That's
product.
All right, because I can't remember what the third one is called.
But
doesn't matter.
Those scores would be generated by each of those companies. Fair Isaac's product is going to be branded as their product, just like a VantageScore is going to be branded as a VantageScore.
Sure.
The key is you can get those scores along with the other scores from each of the credit reporting companies, right?
Okay.
Somebody posted in that it's Equifax Beacon 5.0. Yeah.
There you go. Okay.
Thank you. I'm glad
I have a little advantage in this, and that my wife's best friend was one of the engineers who created the FICO score way back in early 90s, and she's very closed-lipped about the secret stuff behind it, but she would confirm things with me once in a while. It was, so we would learn, okay, this affects your credit score, this, and she'd say yes. But the number one thing I learned, it wasn't from her, but the goal of FICO was to predict I believe it was a 30-day late on a credit card payment. That was the original goal when they sat down and said, how can we predict a 30-day late from historical, credit history? What is the goal now of Vantage? Is it to predict a mortgage late? Is it predict a car payment late?
So VantageScore is a general score that can be used for any product out there. So right now our product And we have two in the market that are really kind of the staples for us, VantageScore 3.0 and the one that was just authorized for the mortgage market, VantageScore 4.0. We are transitioning a lot of folks to the newer score 4.0, but it's utilized in auto space, personal loans, and credit cards.
Right.
Just this month, we've had $2.3 billion in asset-backed securities issued that use VantageScore as the tool to assess credit risk. The majority of that was for auto lending. Toyota Motor Corporation used us, and Exeter used us, and I cannot remember who Exeter is the financier for, but maybe GM. And then there was a personal loan organization, Bread Financial, used us for their credit cards. So we're getting some uptick out there, but our product is more general. It's not. We
It's not
haven't
just for credit cards.
It's not just for credit. It's not just, and we don't have a model that is built just
Well,
for mortgage.
I'm saying that's what FICO started with. The goal was, and what they actually got hired by the credit bureaus, I believe it was, or the credit card companies, to predict a 30-day late. That was the idea behind it.
Well, when we started doing this during lockdown, when the CARES Act rolled out, we had one of the guys who helped put together FICO, like it was 17 years before that. So guess if we had 3 years, 20 years ago, and it was interesting. We will stay away from my opinions on some of that at the moment. So you're welcome for that. So you are your own score unto yourself. Some of the places, so let's say you go get a car loan. Now they're looking at Vantage versus one of the other bureaus. I mean, when I bought a car, even though, it felt like my credit was run 27,000 times, but by one entity, by the way, it wasn't even like being sold somewhere. So anyway, that's here nor there. So tell us, what we're looking for, I believe, is some sort of reasonable explanation of the difference between Vantage and the other three bureaus. What do our clients need to know as far as what is going to change? There's a lot of talk about things like utility bills. I mean, are those included? Are they always included? Are they voluntary? Are they, tell us about the product, Tony.
Yeah. So, I'm not going to talk to about the other companies because I don't have purview into the secret sauce for them, but VantageScore 4.0, part of the reason that it was utilized or it was authorized by FHFA for the mortgage space is because it does take into consideration a lot of that other information that the government and consumers are interested in having be used to evaluate them. That would include utility payments, telecom payments, and rental payments when those are reported to the credit reporting companies. So there's a lot of push now, both by industry folks, and they're doing this voluntarily, trying to get a lot of the mom and pop and some of the other some of the bigger rental companies out there right now to report into the credit reporting companies. There's also a push in Congress to try to provide some incentive as well as a mechanism to have that information reported in. People recognize that it doesn't make sense that you can have someone who is qualified to make an $1,800 to $2,500 a month rental payment, and a lot of times in that same market, that be either equivalent or higher than what they would be paying in a mortgage. But because that payment was invisible to the credit reporting companies, it not be used to determine their credit worthiness. Now, the key is there's always been this opportunity to manual underwrite. And if you remember the mortgage market prior to the utilization of a lot of the underwriting engines, that kind of information was input into the decisioning, right? But once we got into the automation, a lot of that fell out, mainly because there was no single source or sources of information that would provide it on a basis that meant everyone was covered. So we've kind of gotten away from that. Now we're getting back to it because we recognize that is a predictor. So VantageScore 4.0 includes all of that. FHFA, the rationale behind transitioning from the FICO score that people use for mortgages now to VantageScore 4.0 and FICO's 10T product is that they want to utilize those additional data points that come through the credit reporting companies. And if we get a significant push by the government and industry, I think we can begin to collect more of that information so that it covers the entire country. And a lot of the folks that are out there renting right now, where we don't see that, hopefully that'll be seen.
Okay, so is it voluntary to have your utilities on there? And at what point, I mean, if someone's not paying their car loan or their credit card payment, and then does adding, let's assume their utilities are probably not paid on time either. I mean, does that help? Like, make it worse?
So
To make it worse, right? And do you choose whether to have your utilities reported, or do you have to consent to that? Or are you guys pushing for it to be automatic?
So right now, a lot of that is by consent. And if people put it in, then it's in there and it's utilized either for their benefit or to their detriment. The Congress is trying to figure out a way to have all of that information, not just voluntary, but put into the system so that it can be used by everybody. The key is, if you're paying your bills on time, then scores reflect that. If you're not, then scores don't. The one thing I will say, though, is another reason that FHFA wanted to move to VantageScore 4.0 and the FICO product that kind of mirrors what we do is we take a look at trended data as opposed to point in time information. So right now, you go out and somebody will look at, what are you doing literally right now in terms of your business. And if you've missed something in the last 30 days, that pops up, or in the last 90 days, that pops up, and that's it. That's what the score, that determines your score. Right now, we're using trended data, so it allows us to take a 24-month look at each individual. So maybe in the beginning of that 24 months, you've had some bad things happen, but you've cured them. And over time, we've seen the progress. So that allows you to have potentially a better score. Works the same way backwards. Maybe you were doing really good, and all of a sudden some things have popped up. So now we see that, and we're able to make the score appropriate. Or there's something in the middle. But the key is with the trended data, one, you get to see these ebbs and flows and how people handle adversity and whether or not they handle it well or bad, or if something happened in the past and we don't want to see it really impact them because they're doing a good job now. So that's that. The other thing it does is for people who have very thin files, where in the past we weren't able to come up with a score, now we have more data points that allow us to take a look at what they're doing. So those more data points allow people with thin files now to be scored, which is a good thing. That allows more people to have the potential to participate in the financial markets. But it also facilitated the use of bringing in some of that other data, because now, now all of a sudden you're looking at what someone's done over 24 months. Now you want to know, have they paid their telecom on time? Have they paid their utilities on time? What are they doing with that rent payment? Because if we're able to look at 2 years of data and come up with a score, we want to see all the data. And I will tell you that in Washington, there is a bipartisan push to figure out a way to do that so that we have all the information that we need to assess a consumer's risk, but being mindful of their privacy as well. I think that the only divide that you run into in Congress is whether or not all the data is used or just the good data, right? And I think a lot of people are beginning to sit there and go, you know what? I think all the data needs to be utilized. So that's something to be on the lookout for. I cannot remember off the top of my head. There is at least one bill floating around the House of Representatives and the House Financial Services Committee that focuses on this. And I know Senator Scott over in the Senate also has that. So I think that would be.
I think it's interesting because we are seeing, like, VA is changing their policy, or has changed their policy, so that medical collections and charge-offs are no longer going to be considered when you're looking at whether or not someone should get a VA loan. So to me, that looks like a move away from, okay, we should see everything, and a move towards, okay, some of this stuff is less important. And so I guess the question becomes, well, first of all, as an LO, we need to get the word out that you better be paying your PG&E bill on time, even if it is $1,600 a month. otherwise, you know, your score is going to change, and perhaps not for the better. So how, like, I'm just curious about, as you implement a change like this, what impact it has, and whether, you know, I don't know, does it?
So the medical debt
Well,
piece is pretty interesting, right? Because the administration basically came out and said, for any government lending program, we don't want medical debt and medical collections utilized in the determination of the score. VantageScore has pulled all medical debt collection out, and the reason that we did, and this is available on our website, this white paper, is we found that it was not indicative of whether someone could pay or not. I mean, it really had very, very little indication about their ability to pay debt, period.
Exactly.
We
We'll
also
go back to the
recognize,
original purpose of the FICO score, to predict where
right?
you're gonna get late.
All the scores are to determine whether or not the consumer is a viable credit risk, and when they are going to go late, if they are going to go late, right? This is the attempt to take all of that data that was being collected by the financials and really drill it down to one data point that will tell you quickly
Yep.
how that consumer is going to
Better than-
perform. Yeah. And they were trying to make it so that there was some standardization, right? Because if it was left to me to review 5 different credit files, I'd probably review them 5 different ways, or at least 4 different ways, right? Maybe 2 would come out similar, but the other 3 might not. When you've got these scores, now you have the ability to remove any of that human interaction and standardize the process. Doesn't mean it's perfect. Now you can't say it's perfect, but that's why we're always trying to refine it, which is why you always have changes to the models and more inputs. And the government, along with industry, and this is not just the mortgage industry, most industries out there are saying the more information we have about the spending and payment habits of consumers is going to drive how we can determine whether or not those consumers are good risks for whatever debt we want them to assume.
So the current system, you get a score for each of the 3 credit bureaus.
Yep.
And then usually they take the middle score, depending, some lenders have different rules, but that's generally the rule. You take the middle one because there's little variations. TransUnion might not have caught a collection, or, Equifax may have caught a 30-day late with Macy's that the other ones didn't catch. And so that's why there's a little variation between, and that's why you take the middle. But Vantage, the scores are completely different. And it's usually the biggest where we get clients come in like, oh, I've got an 850 score. And I'm like, yeah, you're looking at your Vantage score. We don't look at Vantage scores. So, and I get their credit, and it's okay, but it's 720. It's not 850. And I see that a lot with clients, and it's a very big misnomer about it. I mean, I've even had people in the banking world get it mixed up. How
so it's funny,
reconcile that in going forward if the scorings are so different?
So there are a couple of things that go into that. One, it depends on which score you're comparing it to, and it depends on which bureau you're pulling information out of. Now, I will say this: VantageScore scores are pretty consistent across the 3 bureaus because we pull exactly the same data from each. So the data file, so our scores should not vary compared to ourselves widely. There could be, and we've not done this, and mainly because we cannot do this. We do not have insight into Fair Isaac's secret sauce and how they make theirs. And there's also legal obligations that prevent us from doing comparison side by side. But the one thing I will tell folks is, and this is what we've been telling people as this implementation for the new credit scores in the mortgage space begins to tick closer and closer, you need to begin to pull the 2 scores, the 2 new ones that are being authorized for the mortgage market, and compare them to the traditional score and figure out what that comparison is, or how those 2, how they link up for your own knowledge going forward. It's not something that we can do, but it's something I think that the market needs to do in order to effectively move forward. The easiest thing to be able to do is to compare the two new scores together. But the piece that's going to be a little bit harder is how do you compare the two new scores that have more information and are more predictive to the score that is older, doesn't have as much information, it may not be as predictive. But you do need to work on correlations between those so people can better understand what that transition is going to look like. Because a score of 720 in the traditional space is not going to be equivalent to a 720 on the new scores. And folks need to know what that means. And really, the people that need to know what that means are the folks conducting risk analysis, because what they're going to want to know is what is the percentage risk of this new 720 to go delinquent in 30, 60, 90 days compared to what we know that risk was in the traditional score.
Okay.
But all of that is going to require folks in those risk departments and modelers out there for investors to really get that data in and begin to do that analysis themselves. You guys mentioned FHFA and the hearing that Sandra Thompson was going on. That started at 10 o'clock. And oh, by the way, I believe it's still ongoing. So we're 4.5 hours into it. So there are a lot of questions about what's going on over at FHFA, and some on this change of credit score and change of tri-merge to bi-merge. But the key is, and this is what we've told FHFA, this is what we tell, like I said, our investors, this is what I'm telling you guys. The sooner you begin to understand the scores and how they relate to one another, the better you'll be, the better prepared you'll be for day one implementation, and the better you'll be able to serve the consumer going forward. Because once the consumer starts to hear about these new scores coming up and how they're supposed to be more inclusive and how they're going to bring in more data so we can better understand them, they're going to want to start to utilize those new scores in the marketplace. And the longer it takes us to understand how they play, the longer it takes to be able to use them. And that's going to be to the detriment of a lot of folks who could actually benefit from it.
Well, and that's why we're doing this today and not waiting until it rolls out in 2024 and 2025.
Yeah.
So we can start getting the word out, so we can have people start educating their borrowers so that they are ready, or at least as close to being ready as we can get, without a bunch of companies who won't share their algorithms with us and let us know what the hell they're actually doing. But before we get into the bi-merge versus tri-merge thing, which I'm very curious about, I just want to go backwards a little bit and thank Tina, who clarified it's Equifax Beacon 5.0, Experian Fair Isaac, and FICO score risk score classic 04. It's either classic O or 04, classic 04 or classic 04. It's that. I'm just kidding. So anyway, it is there are so many comments rolling in. Before we start getting to those, I want to talk about this bi-merge versus tri-merge. So we know that we have pulled three reports from 3 bureaus and picked the middle score previously.
Yeah.
Now we know that there is a new thing called a bi-merge. And so we're going to have 2 scores, and you keep talking about 2 scores. So explain how it's going to work going forward and how that works within the context of, we had 3, we're adding you, presumably 1 more, and then that now we're at 5. Are we at 5 or is it still 4? And
yeah, it's a mess.
Which one should we pick? Good God.
You know,
Go, Tony, go.
Yeah, it's a mess. And FHFA was pushed a little bit on their communication on this. You know, could they have done better? Could they share better information to the market? And granted, yes. So there are 2 different things going on there, right? So when I talk about 2 scores, I'm talking about the mandate by FHFA to use 2 credit scores when evaluating a consumer. Okay. So in October of last year,
scores. Just 2 scores.
Well, you can call them new scores, because in October of last year, FHFA said, 1, we're moving away from Fair Isaac's Classic, what we normally use in the mortgage space right now, and we're going to upgrade to VantageScore 4.0 and FICO10T. Those will be the scores that we use in the mortgage space in the future, from whatever day 1 of implementation is. Right now, that looks like Q4 2025 is the day that the traditional FICO goes away permanently. So when I talk about the two scores, I'm talking about everyone pulling at least VantageScore 4.0 and FICO10T, because the mandate is that both scores be pulled together. So if we remained in the tri-merge space, you'd be pulling a VantageScore 4.0 and a FICO10T from each of the three reporting companies.
So that would six pulls?
So that would have been six. So that would have been six, right? But along with that mandate that you pull the two new credit scores, FHFA has also said we are no longer going to require that you pull it from three reporting companies, but you pull it from two. So instead of it being six scores, it's four. One from two FICO 10T, two VantageScore 4.0, one from each of the bureaus that the loan officer selects. Now, the one thing I will say is there's a lot of conversation about what that means, how you rationalize all that, how it fits into decisioning trees. I can't speak to any of that because the jury is still out on that. And that's part of what was being discussed, or what is being discussed in the hearing today. It's also what you guys should be hearing through some of the roundtables that Fannie Mae and Freddie Mac are conducting. Well, they've only conducted one each. And I think the first one was this, maybe the second week of May, and then the 17th was Freddie Mac's. I don't know if they plan to do any more, but I would say if they do on this subject, you probably want to listen to them because they're going to tell you what are the rules of the road, or where they are in development of the rules of the road for this. The rationale behind that, just so everybody knows and we'll level set, is because FHFA believed that moving from 3 credit reporting companies to 2 credit reporting companies would reduce costs and remain as predictive in terms of risk of the consumer as the tri-merge. Again, people are still having conversation around why they think that's the case, whether or not it will be the case, how they plan to move forward. What
can the loan officer pull all the things and then pick the best ones? And
well, and there are rules related to that. So at least in the initial FAQ that came out from FHFA via the GSEs, it says that you cannot do that, right? You cannot pull a report from each of the bureaus and then select the 2 best. If you happen to do that, then you have to submit all 3, which to me is a bit confusing because they say they're not going to accept the tri-merge, but in that instance, they're accepting the tri-merge.
The other thing too is, sometimes clients come to us from other sources, and I might see their credit scores, and I'll say, well, I'm not going to pull the Experian credit score. I'll pull the TransUnion and the other ones. And
yeah, so right now they're
given the choice. I'm just saying.
No, and we get that, and I get that, and I know that was a question that was brought. I cannot remember the congressional member who brought it up. Yeah, but that was a question about gaming the system. Right, that was brought up today in the hearing, and effectively the director of FHFA said we're still working on that. That they've heard
gaming the system. We're just using the information we have to the borrower's best interest.
Yeah, and I believe it was Sandra Thompson who said that it is actually our job to present our clients in the best light.
Well, so I'm not going to disparage.
Other things of late that we may question too, though. So there's that.
Well, I think that the one thing that I will say in defense of FHFA is they were mandated to kind of go down this road. So there was a piece of legislation that was signed into law back in 2017. So in the past administration, the last administration signed it into law, which basically forced FHFA to begin to look at improvements in the mortgage space around credit scoring and everything that they're doing right now. So they have been mandated to make these changes, and they've been mandated to do the due diligence. I believe that they've done a lot of the due diligence because they can't really implement anything by law if they haven't. I think the biggest issue that they've had to this point is they haven't effectively communicated the rationale behind the changes and shared the information that the market needs in order to, and I don't want to say get comfortable, but really understand how these changes are going to impact the current business as well as business going forward. I think that has to change. Once that does, and more information gets out there, I think the more you'll find people will be probably more accepting of the changes that are coming, and they'll see it as a benefit because it potentially can grow your business by expanding the opportunity for home ownership to more folks. On the refi side, it could potentially open up for some people who've been living in properties for a long time and have, great equity, but just can't tap it because they either don't know their credit score, they have something bad, and it's been thin to this point. They've just never been able to really get back into the financial market. So there is the possibility there. So I think there's a lot of good that could come out of it, but the execution is going to be the key. And the folks who are on this call, along with you all, are the ones who are on the front lines to really make sure that it works appropriately and effectively.
Yeah.
It's not going to be the decision makers in Washington. It's not going to be the heads of the big companies. It's going to be the LOs. It's going to be the risk officers. It's going to be the underwriters, anybody in servicing. All of the folks who deal with the consumer on a daily basis are going to be the people who are going to have to implement these changes in the best way possible to support the consumer, but more importantly, to support the industry so that it operates effectively. So that's why that's one of the reasons I'm on the call with you guys today, but because I want to share what I know. But the other thing is I'm hoping to call you all to action to really pay a lot of attention to these changes that are being implemented and listen a little bit to what folks are saying specifically in Washington, because those are the policymakers, and share your perspectives, because you are the folks who deal with the consumers on the front line. It's one thing for me to share my perspective from a guy who used to work at Freddie Mac, a guy who used to lobby for the realtors, a guy who now works for VantageScore. I am away from the consumer, and I can tell you how those policies will impact whatever constituents I work with. It's a totally different thing for you who deal with a consumer who comes in, maybe has some struggling credit, or has been pristine in their payments, but doesn't have a thick file, and you're trying to get them in the process. Sharing those stories, sharing the things that have caused you angst and have caused them problems, that is what makes this thing work. You need to do it with the policymakers, so that's Congress and the regulator, but you also need to let the trade associations, and I know that the mortgage broker is a great trade association for getting out there and letting people know, but share it with all of the ones that touch the mortgage ecosystem far and wide so that we can do this right. So that in the next 20 years, we aren't having to revisit this. And the only thing that we're doing is making improvements as we go.
So a year ago when we were in Washington, D.C., Sandra Thompson spoke to the fact that they'd been working on credit for 5 years. So at this point, 6 years, which would jive with your 2017 bill that you referred to.
Yep.
And it's taken them this long, 6 years, to get from a bill passing to here, we got something, and maybe in a year or two, we're going to launch it, and maybe, but we're not really sure, but hopefully, so stand by on that. And so I just find that the glacial pace that these things occur astounding, first of all. And then so maybe I'm a little slow. Let's just start there.
No, you're right. You're right on the ball. I know you are.
Okay. Let's assume I'm a little slow because I'm about to ask a question that's going to make you wonder. So still can't fathom. I still don't get how the three bureaus. So I read this paper that Equifax produced, and they're really pushing against Vantage, this whole idea of having VantageScore, or at least maybe the buy mergers.
They're not pushing against the new credit scores. Okay. Honestly, I'll tell you, no one out in the marketplace thinks it's a bad idea to upgrade the credit scores. Everyone thinks that's a good idea. The thing that people are pushing against is the idea of going from
3 to 2.
having to pull the scores from all 3 credit reporting companies to 2. Yes.
I can see
So-
that.
So with
Yeah.
all that being said, so here's a Vantage, this is out of Equifax's paper. A VantageScore data study on the entire bureau population indicated data differences drive a 20-point difference on credit score on over 15% of consumers across the 3 bureaus. And there's this whole graph about how you can go from an approval to a decline. But in my mind, what I'm thinking is, okay, first of all, you got to get buy-in from people so that they're reporting to you, right? Or are you buying the information from somewhere else? And so it doesn't really matter whether they buy into VantageScore. You're going to get the information because you're buying it from other sources.
So recognize this, we don't buy our data.
So
From
it's
anybody.
all your data.
All the data that comes to us is coming from our parent organizations.
Okay.
Right.
Oh,
So
you don't
they're
buy
the
it.
three for now.
Yeah,
Okay.
so they're the ones who are going out gathering this
You're getting
information.
data regardless of whether someone believes in VantageScore. Okay, so the
That's
data is fine, right? Like
Yeah.
we're gonna all have the same data. Okay, I got that part now. So we
Yeah,
don't have to
yeah.
worry about that.
So yeah, we're not a company that goes out and, well, one, we're not a huge company, but remember, we're independently managed but owned by the 3 bureaus.
Okay,
So that's wholly different. That's a wholly different model than what Fair Isaacs has, right? They're an independent company. They've got multiple,
Right.
verticals of business.
Yep.
And they are able to do a number of different things that they want to do on their own. We at VantageScore, we focus only on building a score in VantageScore, and we use.
And are you focusing only on mortgage?
No. Our
No?
score is for everything. Remember,
That's what I
our
thought.
score
Okay.
is for everything. So we're only developing a score that can be used for personal loans, auto loans, credit cards, mortgages, anything that you want to lend to somebody. That's what our score is going to allow you to do, or be able to assess the risk in doing that. So that's what I was, yeah.
No, well, I was just gonna say, so oh my God, literally had a brain twitch right in the middle of that whole thing.
No worries.
This is really, I mean, it's interesting because it's so complicated or it feels complicated, and maybe it will work itself out in the end, but right now it still seems just a little, so you're owned and you get your data from the big 3. So everyone will keep reporting to them, right?
Yep.
Okay.
It's the same place that FICO gets their scores. I mean, they get their data from, they buy their data from the big 3.
And then when we go to pull a credit report, we're going to get them somehow. Those big 3 are still involved, right?
Yeah.
Yes.
Okay.
That's correct.
Okay. And how are they involved again?
So remember,
Yeah.
and I saw some people asking about, they had like third-party companies like Credco in there that they buy their scores from. Credco is effectively buying or getting their scores from the credit reporting companies, and the credit reporting companies are selling to Credco a VantageScore or a Fair Isaacs score.
Right.
And moving forward, that's what people will buy beginning fourth quarter of 2025 in the mortgage space. So it doesn't matter what, mortgage brokerage you work for, what retail shop you work for, whatever engine that you use to bring in credit scores, they're going to pull in 2 scores per credit reporting company used. So if you decide that you want to buy an Experian score and a TransUnion score, or an Equifax score and an Experian score, or an Equifax and TransUnion, however you do it, either direct by going to them or through a third party, you're going to get 2 scores, a VantageScore 4.0 and a FICO10T for each of those reporting companies that you choose. And then that feeds into whatever your decisioning system will be.
I figured out my question.
Okay.
So in the past, if somebody says, I just bought a car and my score was X, that was going to be different than our score because we had a different modeling, right?
Yes,
So you're saying that Vantage is the same for everyone now?
Yes, that's correct.
So when somebody goes to buy a car and gets a Vantage score, it will be the same score I'm going to pull.
That's right.
Same
If it's
VantageScore.
if it's a VantageScore 4.0, or if it's a VantageScore 4.0. Some people out there right now still use VantageScore 3.0. So if you look at Toyota, it'll be a VantageScore 3.0, and that will be different than a VantageScore 4.0. The key is the risk modelers at Toyota understand the difference, because we put out tools that anybody can utilize, and they can see them free on our site. The one that they would be utilizing for this is called risk ratio, and they can see what a VantageScore 3.0 in every tranche looks like compared to one in the VantageScore 4.0 tranches. So you get to see the difference in the delinquency ratings. But you're right. Going forward, once everybody in the personal space, auto loan, credit card space uses VantageScore 4.0, and we're using VantageScore 4.0 in the mortgage space, then the scores will be the same.
All right, so I had a thought,
Did you
and
just feel like you had a moment of clarity there, folks? Because I did, just for a second.
a little
Like,
bit.
oh, that.
But remember, that's on
sounds
our
good.
side. That's on the VantageScore side.
Yeah,
Because
yeah.
again, we don't build models for specific business verticals. We build one model, and we improve them, because obviously at one point we had a VantageScore 1, we had a VantageScore 2. That's why we're at 4.0, right?
There'll be
At
a
some
5
point we'll have.
soon.
At some point there'll be a 5, right? Now that's not going to be authorized for use in the mortgage space. It's only going to be 4.0, and that's another discussion that FHFA is having right now. How do you, what regimen do you put in place to update the current scores so that we don't have the same issue we have now with Classic, with the traditional score, in that it becomes old and doesn't reflect the populace? But it's probably not going to have all the bells and whistles of the next score up, because the evaluation process, per Audrey's note mentioned a few minutes ago, took 5 years. So you don't want to have a new score come into place and it take 5 years for them to now implement that. So but they're still talking about those processes. That's why I say it's imperative for the folks on the phone, on the video feed, to really, pay attention to what FHFA is saying. Pay attention to what the GSEs are promulgating. Listen to what the trade associations are saying and taking back, because that's going to really determine the guidance and the rules for the road moving forward. And you're going to want to have some say into that if you don't think that the rules that are being promulgated right now make sense.
I promise we will keep on top of this, and I promise it will get more clear as we go forward. It reminds me a lot of having an iPhone 6 and not doing any updates, and then they've upgraded and upgraded and upgraded, and all of a sudden you're in the dust, your phone doesn't work. I mean, at what point do you just retire? Like you've retired Vantage 1 and 2, and now we still have 3, but now we have 4. At what point does 3 just get so we don't have to worry about it anymore? I mean, would it be nice if we were all on the same freaking Vantage score? Come on, be a
Well,
trend.
for mortgage, you will. For mortgage, you will.
I know, but I'm saying,
And
if
I
they get a
think,
car loan, or if they get a credit
Yeah.
card, I mean, it'd be nice if it
So-
was all the same.
no, it makes a whole lot of sense. But the other thing that people take into consideration is cost. And again, I don't know the cost what our parents charge for our score, but probably a 3 may be different in price than a 4. And if people think that they're getting what they need out of the 3,
They're going to go
then
to the 3.
they'll keep
I
riding
see.
that train until it bucks them, and then they'll move on to the next one. So those are individual decisions made by the companies that utilize the score. But for the mortgage industry, it is VantageScore 4.0.
Right.
Kind of like
So
why I
we
only
do have-
upgrade my iPhone every couple years, because the older version still works and does just fine, even though the new one kind of gets some fancy bells and whistles, but I don't need the fancy bells and whistles right away.
Yeah, exactly.
So something I wanted to get tightened up on, and that's the 2 versus the 3 credits bureaus being pulled.
Buy merge versus try merge. Gotta get the lingo right. Buy merge.
Okay,
Buy merge.
got it. So let's say one of the reasons right now, if I pull the tri-merge and for whatever reason, let's say TransUnion doesn't score because there's not enough credit history, but the other 2 score, I can use the 2 scores to go ahead with the transaction. But if I'm only doing a buy merge, now I might have only 1 score. What then?
Yeah, so that's part of the rules that the GSEs and FHFA are still coming up with, to be
Trying to
quite
figure it
honest.
out. Because
they're
otherwise
trying to
they
figure
just
out-
eliminated a
that
whole bunch of
worked out
buyers.
Hey, but I will share, and there is a I'm sure you guys have heard of MISMO, the Mortgage Information Maintenance Service Organization or something like that. It's a group that comes up with standardization and rules for implementation in the mortgage market. Those guys are getting together to try to answer some of these questions, and then they're going to share their findings with FHFA. They aren't the only people, so that group is not acting in a vacuum. There are a number of different groups of people in organizations that are finding gaps like that, like you just mentioned there, Kevin. Right. And they're sitting there going, well, what does that mean moving forward? And how do we reconcile that? So one, they've identified that issue for the GSEs. And to be quite honest, I'm sure the GSEs know, but just to make sure they know, to make sure they know. But then two, most of the industry is trying to figure out how would they handle that and making that suggestion. And if they can come to a consensus, then they can take that to the GSEs and say, oh, I understand you may have some work out. This is what the practitioners are saying. So maybe consider this. Again, another reason for having folks pay attention. I see that I think that's Tina Broyle said, sounds like nothing is changing yet. Yeah, you're right. Nothing's changing just yet.
This is all about getting our buyers ready.
Well, the big thing is,
this about
I think the big change is, you got to start letting your clients know that maybe they're not making their utility payments right now because, no one's ever going to report on that. It's not going to show my credit report. Well, if you fail to make your utility payment on time today, when this comes active 2 years from now, it's going to hurt your score.
Yes,
that's right.
That's right. The big thing.
That's very sweet of you, Tony. He says it could. Let's just be clear. It will. And Monique was asking questions about the money, and Tony has clearly indicated that he's not talking about money today. You need to go talk to your mother. I'm not going to cover that one.
But you know who you can talk to about costs, and I think this is a great conversation for everybody on the phone. If you're interested in cost and how things could impact your consumer, go to the credit reporting companies. So whoever's pulling the data for you can give you the cost. I think that would be a great place to go.
We do, and we actually have had conversations with the CRAs, right?
That's close enough.
Right? Anyway, we do have those conversations. Everyone always kicks the can down the road. It's not our cost. It's not our cost. Ultimately, I think, because we haven't talked to FICO in a while, it's their fault. So that's what I'm
saying that on all this.
It's FICO's fault. What?
I'm not going to say that on video.
Of course you're not. And I'm pretty sure you just called some people cats, but just caught yourself in the nick of time. It was very close, but I caught it. So Tina is saying that she was taught not to pay off her credit cards in full, to leave $30 as an ongoing balance. Is that going to be obsolete at some point? That's not your department, is it? Like,
no, that's not really.
But someone else,
somebody who works the algorithm. But I think that the thinking is still sound, right? You want to have active credit out there, and part of the reason that we've gone to these trended scores is because people didn't have a lot of active trades. So having a balance, paying it monthly, showing that you're handling and monitoring or managing your debt, I think that's still going to be beneficial, regardless if we're looking at you at point in time or over time. The thing that you don't want to have happen, or in the past that you didn't want to have happen, is you didn't want to lose the trade lines, so you became a thin file and nobody could score you. Correct. Now you can become a thin file, but do you really want to?
No.
I think that depends on. It really depends on your preference as an individual, but if you really want to make sure you participate in the financial markets, you need to show that you're paying.
No. We can't accept that. I just had this conversation with a client who happens to be my brother-in-law, and he's like, "Oh, I just don't like to have these open accounts." I'm like, you stop that nonsense. If you close one more account, I'm going to beat you. So we need to guide them gently or not gently, depending on your relationship with someone, and help them understand the way forward is X, Y, and Z. It's very clear. There's no discussion really.
We
And
definitely have
there
to
was a
get in
comment.
there.
There's a comment here that you should take back to your people here, Tony. I hope my Cox bill payment is, Cox is, I think it's.
I know
either
Cox.
somebody's
You said
down
Cox
south.
Tom.
Yeah, anyway, is not counted because it's not indicative of my ability to pay, just a reflection on how much I despise the way they treat customers. So make sure you make a note of that, Tony. That's
I like
a
that.
very important one, right?
We want to have some sort of notification in our system that says, I despise the creditor.
Right. The creditor sucks.
I love it.
The creditor didn't
I
respond.
think you can put that in the comment section.
Well, yeah, but it doesn't count for bupkis, does it? What good does it do? It's so
That
annoying.
actually hurts you because you got a comment in your comment section.
Yes,
Yeah, right.
exactly.
We have to do a session on credit scoring and how it all works and things you can do, like, do you leave $10 on your credit card? Does that, because the theory is that you are showing that credit card companies can make money off you, therefore it's better for your credit score. And this, I've heard all these little things.
We've done that, but it's probably time for a refresher for sure.
Yeah.
So we have a question. When will Vantage start being used? Please clarify. Is Vantage going to replace FICO in the DU and LP underwriting process, or will both scores be used? And the reason I read it verbatim is because the person who wrote it, I'm afraid that he'd come and put me in timeout if I didn't get it right. So did you get it?
Right. I got it, and I will answer it. I only have 2 minutes, and I apologize. And hey, look, I will come back. I will come back. I know it's almost 3 o'clock. Can you imagine? We've been here on the phone an hour. But I will definitely come back and we'll do this again, because I think that there are more questions that people have, and plus there'll be more information to share. So to get to that question, third quarter of 2024, the timeline indicates, this is the FHFA / Fannie Mae Freddie Mac timeline, says that VantageScore 4.0, FICO10T, and the classic score will be pulled for each origination submitted to the GSEs, which means that LP and DU will be able to handle at that point in time,
right,
scores, each of those scores.
So when you're oh, I'm so sorry. Go ahead.
No. And then in the fourth quarter of 2025, after you've had about a year and some change to pull all 3 of those scores, the traditional score goes away, and beginning the fourth quarter of 2025, it is only FICO10T, VantageScore 4.0 that will be scored and submitted to the GSEs. That's according to the current proposed timeline, which we're keeping fingers crossed that they will continue.
And just to be clear, this is all subject to change at any moment.
Mm-hmm.
And that was crazy. I literally have a pile of other information to go through with today. That's insane. So
Audrey, I'm here. You can call me anytime.
Okay. Oh, and
I'm available. I know you will.
Oh, I will. And
Yeah,
by the way,
she blows up my phone all the time. So believe me.
All the time is a little hyperbole.
3 times.
A lot of the time.
Whatever.
Yeah, call this.
Okay, so Tony, thank you so much. I know you have to go. We so appreciate you. Guys, next week we have Dan Habib with MBS Highway with us. He is always a wealth of information, and I will try to get to the rest of what I had for this week. Then with that, join us on YouTube, Mortgage Pros 411. Thank you, Tony. Mwah. Have a great
Thank you.
guys.
Good seeing you all.
Bye-bye.
Talk soon.
Take care.
Bye.